studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When most people think about taking money out of a corporation, they usually think of salary or dividends. However, for owner-managers, the reality is much broader. A shareholder can receive value from a corporation in many different ways. As shown in this diagram, a shareholder might borrow money from the corporation, use corporate assets, such as a company vehicle for personal purposes, claim home office expenses through the corporation, receive medical benefits through corporate structures, or even use advanced retirement and wealth planning strategies. All of these interactions fall under the broader topic of shareholder loans, shareholder transactions, and alternative compensation benefits. These arrangements can create valuable tax planning opportunities when they are structured correctly. For example, certain reimbursements, benefit plans, and planning strategies may allow business owners to extract value from their corporation in a tax-efficient manner. However, these same transactions can also create significant tax risks if they are handled improperly. The Canada Revenue Agency closely examines situations where personal and corporate finances become mixed together. A shareholder loan may become taxable. Personal use of corporate assets may create a shareholder benefit. Improper reimbursements can lead to reassessments, interest, and penalties. As tax preparers, it is important to understand that every movement of value between a corporation and its shareholder has potential tax consequences. The goal is not simply to record the transaction, but to determine the correct tax treatment and ensure compliance with CRA rules. This section provides the foundation for understanding how shareholders interact with their corporations and prepares us for the more detailed rules that follow in the rest of the chapter. To understand shareholder loans and benefits, we first need to understand why these issues arise so frequently in small business corporations. In many owner-managed businesses, the same individual wears multiple hats at the same time. They are the owner of the corporation, the manager running daily operations, the employee performing work, and the decision-maker controlling the company's finances. Because one person occupies all of these roles, the line between personal finances and corporate finances can easily become blurred. This overlap often creates situations where money moves between the shareholder and the corporation without proper planning or documentation. For example, a business owner may pay personal bills from the corporate bank account. This creates shareholder transactions that must be tracked and reviewed. An owner may withdraw money from the corporation without formally declaring a salary or dividend. This creates a shareholder loan balance that may have important tax consequences. Another common situation occurs when a shareholder uses a company vehicle for personal purposes. In many cases, this creates a taxable shareholder benefit. Similarly, personal medical expenses may be paid through the corporation. While this can sometimes be a legitimate planning strategy, it must be structured correctly to comply with CRA rules. The key lesson is that most shareholder loan and benefit issues do not arise because someone is intentionally avoiding tax. They arise because owner-managers are focused on running their business and often treat the corporation and themselves as if they were the same entity. From a tax preparer's perspective, this is why shareholder accounts require careful review. Every transaction must be analyzed to determine whether it represents a shareholder loan, a shareholder benefit, employment income, a reimbursement, or some other form of compensation. Without proper planning, personal and corporate finances become mixed together, creating unexpected taxes, penalties, interest charges, and potential CRA reassessments. Understanding this reality is the first step toward helping owner-managers stay compliant while minimizing their overall tax burden. Now that we understand why shareholder transactions occur so frequently, the next step is understanding the three main ways a shareholder can receive value from a corporation. Most people immediately think of salary and dividends, and while those are certainly important, they are only two parts of the bigger picture. The first category is salary. Salary represents employment income paid by the corporation to the shareholder in their role as an employee. Salary is reported on a T4 slip, is subject to payroll deductions and CPP contributions, and creates RRSP contribution room. From the corporation's perspective, salary is generally deductible, which can reduce corporate taxable income. The second category is dividends. Dividends represent a distribution of corporate profits to shareholders in their capacity as owners. Dividends are reported on a T5 slip and do not require CPP contributions. Shareholders may also benefit from the dividend tax credit, which helps reduce the overall tax burden associated with dividend income. Most tax planning discussions focus heavily on choosing between salary and dividends. However, for many owner-managers, the third category is equally important. The third category includes other benefits and transactions. This covers a wide range of financial interactions between the shareholder and the corporation. Examples include shareholder loans, personal use of corporate assets such as vehicles or property, expense reimbursements, medical benefit plans, and many other arrangements. This category is especially important because it is where many CRA issues arise. Unlike salary and dividends, these transactions are often less formal and can be overlooked during the year. As a result, they frequently lead to shareholder benefit assessments, loan inclusion issues, and tax reassessments when not handled properly. The key takeaway is that shareholders do not receive value from their corporation through only salary and dividends. Many also receive value through loans, benefits, reimbursements, and other transactions. As tax preparers, our job is to identify which category a transaction belongs to, apply the correct tax rules, and ensure that the arrangement is structured properly. When done correctly, these strategies can help reduce taxes while maintaining compliance with CRA requirements.